Hello, friend. I'm your friend Kaustav. A lot of my friends they told me, "Ki Kaustav, you always tell कि everyone should invest small portion at least of their portfolio into direct equity, or as per their risk appetite, they should invest in direct equity." Can you tell me why? In my previous video, I have explained why you should consider Indian equity. Right now, in this video, I'll explain to you why in your portfolio you should have at least small portion of direct equity. I am talking about investment. So you are investing into a business. So I am not talking about FNO, intraday, this particular portion. So it required different kind of mindset, different kind of skills. But what I am talking about long-term investment into equity as a asset class. Number one, direct equity has potential to give you better return than other asset classes, such as maybe bank deposit or gold or traditional bond, to some extent real estate. For example, since inception of Sensex to till date, if you calculate average CAGR, compound annual growth of return, is around 15%. So if you compare this particular return with 10-year G-Sec bond, which considered is safest haven for any investor, it is around 5 to 7%, but it is fixed. Equity has risk of market fluctuation. Number two, equity has potential to protect your wealth from inflation. We know in India, our 10 years average inflation is around 6 to 7%. And say for example, if your fixed deposit is giving you 5% return, then every year by investing into fixed deposit, you are losing 1%. On top of that, if you are falling into 30% tax bracket, then in fixed deposit, you need to pay 30% on your return. Compared to that, you can expect double-digit return in direct equity in long run when you are investing into right stocks. Number three, it has ability to give you regular passive, regular basis. They will give you dividend income. When you are investing into high dividend stock every quarterly or annually, some stocks give good amount of dividend. Fourth, pride of ownership. A share of stocks represent fractional ownership of a company. You can own tiny slice of ownership the product or service you love. Say for example, you are earning from somewhere, and that earning of that particular business you are investing into 10-20 highly profitable companies. Say for example, you are taking one companies from banking sector, one companies for other sector like uh, auto sector, one from maybe medical and health sector. From different sector you can take one, two, which companies you like most, or which company you, if you can able to analyze their balance sheet, if you can able to analyze their business model right now, this particular business. So if you can analyze this all this particular thing, then you can diversify your income into different companies, and आपका 10 से 15 दुकान आपका ओपन हो गया. And that means you open 10 to 20 shops. One shop will give you maybe 30% return, one shop will give you 15% return, one shop will give you maybe 10% return, maybe one shop this particular year will give you negative 2% return. Averagely some return will come, right? So like this, averagely you can expect a good return. That is how you should invest into direct equity. Hope it is clear for you. Next, very important thing is liquidity. So say for example, you invested into real estate, land. You have one land. Today you need money. Some medical emergencies or some other emergencies. You cannot sell one corner of land. If you want to sell, you need to sell entire land. Okay. At that point of time, if buyer understood ki you are in problem, definitely they will ask you for lesser price. That particular land sale procedure is very much lengthy. Okay. But based on your risk appetite, if you simultaneously make some portfolio or grow some portfolio in equity. So your portfolio is liquid. If you have very much emergency, that point of time, some portion, maybe you can sell one stock, two stocks, five stocks, actually address your this particular need immediately. In opposite, if you want to buy one land, you need to sell lot of amount, right, into this. Say for example, whatever money you can save, 10%, 20% of your salary of your regular business, you can regularly invest. So in stocks, you have very much liquidity. So whenever you need money, you sell, T plus 2 days, your money would be available. Next, diversification. Say for example, you have one land of 1 crore, but your risk in this land is very much concentrated. Why? Because whatever the growth potential of this particular area, okay, that is only the deciding factor of growth of this particular land. But in equity, what you can do is you can diversify your portfolio in different sectors. Say for example, in your overall portfolio, maybe 20% you can invest into banking sector, 20% you can invest into infrastructure sector, 20% you can invest into medical and health sector, 20% you can invest into auto sector, 20% you can invest into maybe your specialty chemical sector. Based on actually that point of time, whatever is the growth potential, based on the growth potential, you can invest, you can diversify your portfolio into different sector. Because of that diversification, your risks will diversify. It will not concentrated into one place. Okay, so a lot of risk management also can be possible when you invest into stocks. And again, for that, if you are capable enough, then you do it yourself, or else you can go and sit with any investment professional or investment advisor who can guide you in this all areas. Next, ability to start small. So in stock market, you can start small. Maybe you can purchase one stocks or two stocks. When you are not capable enough to do proper analysis, don't consider with penny stocks. You go with maybe Nifty 50 stock. You can talk to your finance professional. So hope you understood why you should invest in direct equity.